investors. Welcome back to another episode of your investment playbook for 2026. In the last few episodes, we spoke about setting your own personal financial goals and understanding your current financial situation, as well as building the foundation for your personal investment plan. In this episode, we will give you a simplified look at some of the tools you will need in your wealth creation journey. And we will take you through a basic understanding of things like stocks, bonds, treasuries, ETFs, and mutual funds. Of course, we'll do it in a simple, basic language. Now, today we're going to answer one of the biggest questions beginners tend to have. And that is, what exactly should I be invested in? Because once you begin to open an investment account or begin that investment journey, you will see a lot of options. Stuff like stocks and bonds and ETFs and mutual funds, treasuries, and for many people, that's where the confusion begins. However, let's simplify it. Let's break it down. Think of this as learning the basic tools in your investment toolbox. Stocks really are, at the very base, ownership in a company. And when you buy a stock, you're buying a small piece of a company. So when that company grows or becomes much more profitable, then the value of your investment can grow and thrive and become profitable. But if the company struggles, then the price can fall. Stocks are generally best for long-term goals because over the long term, they tend to have higher growth potential. However, investors in stocks should be willing to accept ups and downs in their portfolio and in the movement of their investment. So, the risk level for stocks, therefore, is considered medium to high. The reward, on the other hand, tends to be very high over the long term. One of the biggest drivers of wealth creation throughout history have been investment in stocks or equities, as they call them, especially for long-term investors. The next asset we look at is bonds. Bonds really are debt instruments, and it's really about lending out your money. A bond, therefore, is essentially a loan. It's where you lend your money to a company or to the government, and they in return pay you interest over time. Bonds are generally considered much more stable than stocks and are designed to generate steady income. They're often used to reduce risk in your portfolio. Therefore, the risk level on bonds tend to be somewhere medium to low risk. The reward potential tend to be moderate, and therefore you can think of bonds as that stability layer in your investment plan. The next tool we'll look at is treasuries, and they are one of the safest investments in your toolkit. Treasuries are a special type of bonds which are issued by the government. And because they are backed by the government, they are generally considered one of the safest investment instruments available. Now, some examples of treasuries are generally looked at like treasury bills, treasury bonds, and treasury notes. Now, treasuries are often used by investors who want secure, predictable income streams, and therefore the returns may not be huge, but the safety, reliability, and predictability make them an important part of many portfolios. The next tool up in your toolkit is mutual funds, which really is a basket of investments. mutual funds tend to pool money from many different investors and invest in a diversified mix of assets such as stocks, bonds, and other instruments. So instead of buying just one company, mutual fund allows you exposures to many companies all at once. Mutual funds tend to be best for beginner investors, and also they work very well for investors who do not have the time or skill sets to manage their portfolio by themselves, or for investors who just simply want a diversified portfolio, and also for people who prefer to have an investment professional managing their portfolio of investments. The risk level of mutual funds really depends on which type of fund you get into. So equity funds can carry a higher risk than a bond or money market fund. Of course, the mixed fund would be somewhere in the middle, a moderate risk. The reward potential of mutual funds, however, tend to be moderate to high. The main drawback for mutual fund investments, however, is that mutual funds tend to charge a higher management fee. The next tool we look at is ETFs, which is exchange traded funds. A real modern investment tool in your toolkit, and they work pretty much like mutual funds, but with one big advantage: they tend to have lower investment management fees. However, they trade pretty much like stocks. Many ETFs track major indices such as the S&P 500, for example, which means one can have investment exposure to hundreds of companies by investing in ETFs. ETFs tend to be best for beginners, long-term investors, and offer a low-cost approach to building a diversified investment portfolio. And that's why ETFs have become one of the most popular investment tools across the world. And the last tool we look at for today is high-yield savings or fixed deposits. They are really your safe parking spot. These are not designed for high growth, but they are excellent for short-term savings goals, for emergency funds, and really for protecting your cash while earning an interest. They tend to offer higher interest than the traditional savings accounts, while at the same time keeping your money relatively safe and liquid or accessible, which is very important. Now think of these as your safe parking lot, as I said before, for your money. And so the big question: how do you choose which tool is best for you? And here's a simplified rule that many investors tend to follow. For short-term goals, usually say 1 to 3 years, we talk about high-yield savings accounts, fixed deposits or treasuries. And for your medium term, which 3 to 7 years, you want a balanced mix of stocks and bonds, maybe some money market funds, etc. And for your long-term goals, we're talking about over 7 years, stocks, ETFs, or equity mutual funds. And remember, you don't always need to pick individual companies. You can look at industries or asset classes. You can simply invest in the entire market through an ETF that tracks the index, as I said, like the S&P 500. So, your challenge this week: choose one investment vehicle, one tool from that toolkit that match your investment goal. Do some research on it and take your first step toward investing with confidence. Drop a comment and tell me which one you are choosing, which one you think is right for you. Or comment wealth if you need a one-on-one consultation on building your own personal investment plan. Because remember, we are not just learning how to invest, we're building financial freedom. We're breaking ties with generational poverty and creating generational wealth. If you found value in this episode, remember to like, share, and subscribe. Let's spread the knowledge around. Let's empower our communities in 2026. I'm Nielsen Rose, and this has been another episode from the Investment Playbook. And of course, see you in the next episode.